12월 연방공개시장위원회 FMC는 예상보다 더 비둘기파적이었고요. 파월 의장은 12월 1일 날에는 금리 인하 논의하는 거는 시기상조다 이랬던 사람이 12월 13일에는 금리 인하를 논의하고 있다 이렇게 얘기를 했습니다. 시장은 굉장히 반기고 있는데요. 그동안 많이 올랐죠. 앞으로 시장은 계속해서 산타랠리를 벌이면서 올해 말도 오르고 내년도 오를 수 있을까요? 지금 시장은 연착륙 희망에 굉장히 들떠 있고요. 페드가 이렇게 피벗하는 완화로 전환하는 것에 대해서 굉장히 반기고 있습니다. 하지만 여러 가지 질문이 있죠. 이럴 때 모두가 좋아하고 별다른 위험은 없어 보이지만 어떤 위험이 있지는 않을까? 혹은 시장이 얼마나 더 오를 수 있을까? 이런 거에 대해서 관심이 쏠리고요. 또 금리는 5%까지 올랐던 10년물 금리가 단기에 지금 3.9% 정도까지 떨어졌는데요. 이게 더 얼마나 더 내려갈 수 있을지 아니면 여기서 반등을 할지 거기에 대해서 다들 궁금해하고 있습니다. 그런 질문들을 저희가 네드 데이비스 리서치의 에드 콜리솔드 수석 주식전략가와 인터뷰를 해서 물어봤습니다. What are your thoughts on FMC yesterday?
The market has been expecting the Fed to pivot to being more dovish, that is, signaling they're done raising interest rates. So July was the last hike, and they will be moving towards rate cuts next year. And the Fed met those expectations. There were quite a few people who thought perhaps the Fed was going to have to walk back some of those rate cuts for next year, but the Fed did very little to do that. And so maybe some investors who were on the sidelines, who were a little bit more cautious, felt compelled to get in line with the Fed's fairly dovish policies now.
Mm-hmm. And you expect Powell saying something like that yesterday?
We thought they would shift to being more friendly. I think what was a little bit more dovish than what even we had thought was the idea that there could be 3 or 4 rate cuts next year. We were thinking maybe 2. The market was looking for 5. So the Fed actually moved toward what the market expectation was, which over the past several Fed meetings, Chair Powell has done the opposite, where he's actually tried to move the markets back. So that was a bit of a surprise to a lot of people.
And when do you expect the Fed begin cutting rates next year?
I think they could, it may be in the second quarter. The May meeting could be a target for them. They probably want to see a few more inflation reports that are showing that core service prices have started to roll over again. Those have been fairly, what they say, sticky. Their inflation rates have not come down as quickly. And also to see some more evidence of the labor market easing. There's been some initial signs, but they may want to see a few data points along those lines before they actually do cut. So that could put us into the second quarter of next year, with the May meeting being a good meeting to target.
I'm curious, why did Chairman Powell change his stance so quickly? Because he, in the first of this month, he said it was premature. Thinking about the cutting rate is premature, something like that. But he changed it yesterday. And some argue that there might be political intentions to cut rate in the first half before the second half of presidential election.
I do think the Federal Reserve does not want to be in the middle of the presidential election. So the primary season is getting ready to start, where both parties vote and select who their nominee is going to be. It looks pretty clearly at this point that Biden is going to be the Democratic nominee and Trump is going to be the Republican nominee. So not a lot of surprises there. And so the general election really gets going, in the summer months. And so perhaps what the Fed would like to do is, if they're going to start cutting rates, do it before the general election really gets going. And so that may be part of it, part of the motivation. But I think also that the Fed is recognizing the economics of the situation, where the labor market has cooled. There's some beginning signs of stress from the consumer. Recognizing that they have been very aggressive at this point, maybe it is time for them to start to signal.
I think they recognize also the massive issuance of treasuries in the next year.
Well, yeah, the Federal Reserve is, it's technically independent, right? So that's the Treasury's job. But yes, they have to know what's going on, and And interest expense is quickly becoming one of the biggest line items in the federal budget. So Social Security is the number one. That's the government program that goes to retirees. And then you have Medicare, Medicaid, which are more entitlement programs. And then you have national defense. And then it's interest expense. This is just interest we're paying on the debt we already have. And that is skyrocketing. Yeah, in the next couple of years, that's going to be number two, just behind Social Security. So it is an issue. Although one would expect the Fed to not manage monetary policy to that, because if they do, that could risk an inflation spiral, and then they have to deal with pushing rates even higher in the future. But it is something the markets are focused on for sure.
The yield on the 10th has fallen below 4%. Just right before it was like 3.89%. Do you anticipate a further short-term decline? What is your rate outlook for the end of this month and the end of first quarter next year?
So it's been an amazing round trip where in August, the 10-year treasury yield was around 4% and went up to almost 5%. And here we are back to 4%. So, we continue to be bullish duration. That is, we recommend fixed income investors to have longer than their benchmark duration. So favoring long-term bonds over short-term bonds. Now, over the short term, the next few weeks, we wouldn't be surprised if perhaps bonds gave back a little bit of the gains and the 10-year treasury yield doesn't move back towards 4% or maybe even a little bit above it. But as we move into next year, we think the fair value for the 10-year treasury yield will move toward 3.6 to 3.5%. So at some point next year, we think we could get close to that level as inflation rates come down, economic growth comes down. That would imply more room for the 10-year treasury to drop. But we've come a long way. And so to take a breather at this point would not be too surprising.
And market right now enjoys the pivot of Powell. The stock market has risen by 15% in the past month and a half. And do you think the Santa rally will continue? And if so, how much further do you expect it to go?
We do think it can continue well into 2024. Again, over the very short term, the market is a little bit overbought. We have what we call sentiment indicators, or these are data series that measures how bullish investors are. And given the rally that we've had, a lot of people are bullish. So that would imply a short-term pullback may be possible. But we've also seen the kind of what we call technical action, that is percentage of stocks above their moving averages, percentage of stocks rallying together, advancing stocks versus declining stocks. These have all become extremely bullish. And so that implies that the rally, can continue well into 2024. The Dow Jones Industrial Average made a record high yesterday. We would expect the S&P 500 to follow suit in the next, several weeks to a couple of months, if not sooner. Usually when one of those indices makes a new high, the other one follows. So we think that for the year next year, perhaps the market could rally an additional 7% would be our target, with some choppiness and pullbacks along the way.
Will you change your market and economic outlook for the next year based on the result of the FMC and easing financial conditions?
We have been thinking that the economy was going to achieve the so-called soft landing that the Fed has been looking for. There's a lot of economists have been looking at things like leading economic indicators, which when they turn negative, like they have been, that leads to recession. Usually the yield curve, that is a 10-year treasury yield, versus say the 2-year treasury yield is inverted to long-term rates below short-term rates. That usually leads to recession. But there's lots of other data that hasn't been showing that. If you look at consumer sentiment, if you look at service activity, individual state activity, those were all suggesting the economy maybe is not heading into recession. So we were in the soft landing camp, and I think the Fed potential pivot is getting us closer to that, because the reality of the situation is, if inflation is going to be moving towards 3% or even a little bit below 3%, probably we don't need a Fed funds rate above 5%. They can cut a little bit and still and still be a little bit restrictive on the economy. And so that creates a path for lower rates and a soft landing.
That means you think they will not cut aggressively, right? Just a few times for the insurance.
Yeah. So two or three cuts next year seems reasonable. And so move in the right direction, but I think right now futures markets are projecting 5 cuts next year. So that seems a little bit aggressive to us.
And everybody believes in soft landing right now. What do you see as the potential risk, if there are any? And do you believe that if financial conditions ease further, there is a possibility of inflation rising again?
That is probably one of the two biggest risks. That is, inflation does start to move higher again. It won't skyrocket like it did in 2020, in 2021. But if, let's say, the CPI moves back towards 4%, the Fed certainly wouldn't have room to cut rates, and they may actually move to hike once or twice more. So that would be one risk. The other one is that the mechanism from the Fed policy to the consumer has been delayed because so many consumers in the U.S. have stronger balance sheets than before because of the pandemic and a low unemployment rate. And so as those excess savings are spent, and a lot of it has been spent, that could mean that over the course of 2024, the consumer may feel the effects of higher rates more than maybe what the soft landing case is anticipating. And then the third thing is that the commercial real estate market in the United States is going through a major transformation, with work from home being somewhat permanent or hybrid work being permanent. And that's a slow moving situation because leases are tended to be multi-year. And so that's another risk, that if the commercial real estate market runs into trouble, that can bleed into the rest of the economy.
The Magnificent Seven stocks have led the market this year. And do you expect a similar trend next year? If the U.S. economy has a soft landing, buying small cap will more be promising?
The Magnificent Seven companies, as a group, without getting into individual names, they generally have great business models, and they've also demonstrated the ability to grow their earnings. But they are about 29% of the S&P 500 market cap, and they're about 19% of S&P 500 earnings. So that gap is pretty wide, and so they're going to have to demonstrate superior earnings growth to justify the rallies they've already had. So if we achieve a soft landing, I think there's a possibility that cyclical areas like small caps could outperform, and maybe even some cyclical value sectors like industrials or materials could outperform in that environment as well.
If the U.S. economy has a soft landing and Fed cut rate next year, can you expect the U.S. dollar to decline and stabilize?
We're fairly negative on the dollar at the moment, and part of that is the Fed transition to lower rates, which makes dollar assets less attractive. But also, the sentiment towards a lot of major economies outside of the U.S. has been so negative that perhaps if that sentiment improves, that would make economic expectations outside the U.S. look more promising, which would be negative for the dollar as well.
And gold has surpassed $2,000 per ounce. What are the main reasons you think, and do you see it rise further?
So we think it can actually, from a purely technical perspective, it looks good with the breakout above 2,000, and if the Fed does move to lower rates, that would be a little bit positive for gold, because gold doesn't have a yield, right? So gold is competing against T-bill yields. So lower rates makes gold a little bit more attractive. But I think there's some reasons to think that gold could at least do okay here, if not continue to trend higher.
And there is a lot of money in the money markets, and if the yield comes down more, and where the money in the money market will migrate, to the stock or bonds, or where?
I think one place it could start to move to would be stocks with high dividend yields. So that money in money market funds is looking for a yield. And for a long time, they couldn't get it from money market funds because the Federal Reserve kept rates near zero. Now they are getting a nice yield there. So lower rates may entice people to look for other areas. So dividend stocks would be one place to go. You also could look at corporate bonds, even high yield bonds. If the economy is going to achieve a soft landing, then default risk would be lower, and then it would investors could be compensated for grabbing a little bit more yield in those areas.
Thank you very much. That's my last questions. And thank you for your insightful answers always.
Oh, thank you, and I appreciate the opportunity to come on, and look forward to talking soon.